Welcome to Bayonat, the heartbeat of tech in MENA. We bring you raw stories and sharp insights from the founders, investors, and leaders building the region's startup ecosystem.
It's great to be here. And today we're doing something a little different. We're looking at a case study in what I would call extreme venture capital.
Extreme is definitely the right word. Today, we're doing a deep dive into the Ibtikar Fund. We're unpacking the insights of its co-founder, Ambar Amla, and looking at how you build a venture ecosystem from scratch in, well, one of the most challenging environments on Earth, Palestine.
And we're not just talking about generic challenges here. I mean, we're talking about building a tech sector under occupation through active wars and amidst banking crises where the money literally just stops moving.
So if you're a founder trying to scale, or maybe an investor looking for that elusive alpha, returns that actually beat the market in places most people aren't even looking, you really need to hear this, because this isn't just a story about struggle.
No, it's a story about financial engineering. It's a masterclass in adaptation. We're going to look at the evolution from, PowerPoint investing to disciplined scaling and the creative financial structures they've had to invent to solve the exit problem when you can't exactly ring the bell at a stock exchange.
Okay, so let's unpack this. We had to start with the origin story.
Sure.
Ambar Amle. She isn't your typical finance mogul, right?
Not at all. And that's actually key to the whole thing. Her background is in marketing. She has an MBA, but not investment banking. She moved to Palestine and founded an organization called Palestine for a New Beginning, or PNB.
And it wasn't even about VC at first.
No, not at all. It was about youth employment.
Right, and this is where it gets really interesting. She's looking at the landscape and she sees the big Palestinian heavyweights, the Bank of Palestine, Paltel. I mean, these are massive companies, but they had a problem.
A huge problem, the economic problem. These legacy companies were hitting a hard ceiling. Their growth was just so limited by the political situation, by the occupation, and frankly, just the size of the local market.
Paltel can't just easily expand its fiber network.
Exactly. So the data showed really clearly that to create jobs, you couldn't rely on the giants. You had to create new companies.
But there was a trap. Ambar calls it the hackathon trap. I found this detail so telling about the early days.
Oh, that's such a classic signal of an immature ecosystem. You had all these young, smart Palestinian engineers just jumping from one competition to another.
Pitching an idea, winning maybe $20,000 or $30,000.
And then starving.
Because that money just runs out.
It runs out. But more importantly, it totally misaligns the incentives. Ambar called it survival money, not growth money.
And that's a huge difference.
A huge difference. Founders were optimizing their pitch decks to win a judge's vote for a cash prize, not to build a sustainable business model that customers would actually pay for. It's like eating sugar when you need protein.
Gives you a quick burst, but no real strength.
Exactly. You're not building muscle.
And previous funds hadn't cracked the code either. Why were they failing?
It was a total mismatch. The analysis shows that they either failed because they were writing checks that were way too big for companies that were way too early.
$100 million to a PowerPoint.
Right. Or they were funds that were so bureaucratic and complex that a two-person startup couldn't even navigate the paperwork. There was a missing middle.
So enter Ibtikar Fund 1. This is 2016. They raised $10 million, and their strategy, well, it sounds a bit crazy by today's standards. They were literally investing in PowerPoints.
It sounds incredibly risky, but you have to look at the context. It was really the only move. They partnered with accelerators to catch companies at the very, very beginning. Ambar admits that Fund 1 was about validation.
They knew the write-off rate would be high.
Oh, they expected it. They were writing small checks into ideas, just hoping the founders could build an MVP, a minimum viable product. The real mission was to prove that you could invest out of Palestine.
It was a proof of concept fund.
Precisely. The thesis was just, is there investable talent here? And despite that PowerPoint risk, it worked. They produced real successes like Matchvisor and Cortava. These companies are still growing. It proved to regional investors that the talent was there.
Okay, so Fund 1 proves the car can drive. Now we get to the scale-up, Fund 2. And this is where the story shifts from scrappy underdog to a sophisticated investor. They raised nearly $25 million.
And just think about the timing. This fund was raised during COVID and arguably one of the most volatile periods of conflict in the region. The fact they closed that amount is a huge testament to investor conviction.
Who was writing those checks?
The heavy hitters doubled down. You had major development finance institutions, we call them DFIs, like the IFC and the Dutch Good Growth Fund. They didn't just stay, they actually increased their commitments. And then you had the European Bank for Reconstruction and Development join in.
So this wasn't charity, this was institutional confidence.
Absolutely. But Ipticar didn't just take the money and do the same thing again. They changed the playbook.
Based on what Ambar calls hard-won lessons.
Exactly. Two major strategic shifts. First, the geography. Fund 2 allows them to invest up to 30% of the capital into diaspora Palestinians.
Which is just so smart. It expands the deal flow. They've invested in companies like Podeo in Lebanon, Mental in Abu Dhabi. It connects the ecosystem to the broader region.
Right, it prevents the fund from being an island. And the second shift was the check size. They moved from those small, $150,000 accelerator checks to an average of around $500,000.
And that's the difference between testing an idea and scaling a business.
Totally.
Yep.
They also got a lot tougher on the founders. There's a note here about solo founders. Ambar seems pretty wary of them now.
Why is that?
It's a pattern recognition insight. In Fund 1, they backed solo founders and realized just how fragile that setup is, especially in a high-stress environment like Palestine.
What makes it more fragile there than, say, in London?
Well, just think about the external variables. In a stable environment, a solo founder deals with business stress. In Palestine, they deal with business stress plus movement restrictions, internet blackouts, family safety concerns.
So if a solo founder burns out, the company just stops.
It stops. There's no redundancy.
Yeah.
Now, Ipticar requires guardrails. If you're a solo founder, they demand you bring on a co-founder or at least intense senior-level support. They just aren't willing to bet on a single point of failure anymore.
The other discipline they added was market size. In Fund 1, they backed some local solutions, right? Apps that only worked in Ramallah.
And that's a dead end for a VC. Ambar is very strict about this now. If your solution solves a problem only in Palestine, it's not for them. That's a small business, not a venture startup.
You have to be scalable to get that follow-on funding.
Yes, the startup must be scalable to the wider mini region or globally. That's the only way it works.
Okay, so we have better companies, bigger checks, stricter rules. But here is the elephant in the room. You can build a great company, but how do you get the money out? Ambar has this great quote, "Nothing is realized until you exit."
This is the core anxiety of any emerging market VC, but especially here. You can raise Fund 1 on a promise. You can raise Fund 2 on early traction. But you cannot raise Fund 3 without showing cash-on-cash returns. You need liquidity.
And you're not seeing Palestinian startups ringing the bell at the NASDAQ queue.
Right, so Ipticar had to get creative. They are literally engineering exits. They aren't just waiting for an acquisition. They're structuring the deals to ensure liquidity happens.
So walk us through these creative solutions. This is the part I think investors listening really need to pay attention to.
Okay, so one mechanism is handling what you could call the SME conversion. Sometimes a startup doesn't become a unicorn, but it becomes a solid, profitable small business.
Making good money, but not growing 10x a year.
Exactly. In a typical Silicon Valley model, that's a zombie company. A VC writes it off because it's not big enough to sell. But in a small economy, that's a huge success story.
Right.
So Ipticar doesn't kill it. They use management buyouts and dividend structures. They basically flip the switch and say, okay, you, the founder, will use your profits to buy back our shares over time. They turn a VC bet into a yield asset.
That's brilliant. The founder gets their company back, the investor gets a return.
Correct. Then there are secondary transactions, selling their stake in a later funding round. But the most fascinating one is what they call the structured exit.
I saw that. It's a clause in the contract, right?
Yes. For Fund 2, they included a provision. If a company is profitable but fails to raise a Series A round within a certain time frame, the company is contractually obligated to start buying back Ipticar's shares.
Wow. So it's like a prenup for the investment.
That's a great way to put it. It creates a floor. It ensures that if the company succeeds as a business but fails as a venture asset, the investors still get liquidity. It protects the fund from getting stuck in zombie land.
That is the kind of financial engineering that only comes from necessity. Okay, let's shift to the human side. We have to talk about what happened between 2023 and 2025.
The crisis years.
The war, the restrictions, bank accounts shutting down. I mean, how did they keep the lights on?
It was incredibly close. Ambar noted that partners who had worked with Palestinian companies for years just withdrew. They got scared. Ipticar had to go to plan B, C, and D. But there's a counterintuitive finding here about the founders.
The distraction factor.
Yes. For many founders, work became a solace. It was the only thing they could control. When the world outside is chaotic, writing code or closing a support ticket is a small act of order.
And crucially, because of COVID, the world had already accepted remote work.
That is a massive point. If this had happened in 2015, the isolation might have killed these companies. But because clients in the Gulf or the US were already used to Zoom meetings and remote deliverables, the teams could keep working.
As long as they had internet, they had a business.
Right. The client in London doesn't pause their demand for software updates. So that commercial pressure actually kept the ecosystem alive.
And this breeds a different kind of founder. I love this description Ambar gives. We don't have the tech bro founder culture here.
No hoodies and kombucha taps.
Exactly. No manifestos about changing the world while burning millions of dollars. Who are these founders?
They're industry insiders. They're often older, more experienced. They come from traditional sectors, construction, logistics, insurance. They lived through a specific, painful problem in their industry for years, and now they're building a B2B SaaS solution to fix it.
They're solving boring problems.
Which are often the most profitable ones. And they have what I call existential grit. Ambar says the mentality is just, you keep your head down and keep working. When you built a company while your bank account is frozen, a down round doesn't scare you.
That resilience is a competitive advantage. You can't simulate that in an incubator. But looking forward, there's a new threat: AI.
This is the double-edged sword. Historically, Palestine has been an outsourcing hub. Great engineering talent at competitive costs.
But AI can write code now.
Exactly. The entry-level coding jobs, the bread and butter of that outsourcing model, are threatened. If you're just a service provider writing basic scripts, you are in trouble. Your margin is going to zero.
But Ambar sees an opportunity here too.
She does. She hopes AI allows these founders to leapfrog. Instead of being the labor that builds someone else's product, they can use AI to build their own products faster. It lowers the barrier to entry. One developer can now do the work of 3.
So they move from service providers to product builders.
Exactly. And that is where the real value is.
This changes how VCs measure success, though. Ambar points out that the metrics are shifting.
The era of growth at all costs is dead. AI floods the market with cheap software, so technology itself is no longer the moat. You can't just say, I have a better algorithm.
So what is the moat?
Stickiness, retention. Ambar says she would rather see a company growing slowly, but with customers who use the product every single day, rather than a company with 1 million signups who churn out in a month.
Being indispensable is the new metric.
That's the word. And that actually plays into the Palestinian strength, doesn't it? They've never had enough money to buy growth. They've always had to be efficient.
They've been lean since day one because they had no choice.
Exactly. Amber also throws a bit of a challenge at the VC industry itself. She questions the 10-year fund structure.
She calls it too rigid.
And she's right. The standard model was invented in Silicon Valley decades ago. Amber is asking, does this fit innovation in the Middle East? Does it fit a company that takes 12 years to mature because of geopolitical delays? She's calling for more flexible capital structures.
So looking ahead to 2026, what's the outlook?
It's all about execution. Now, they have to prove that hackathon to global success pipeline is real.
They need those exits.
They need those exits to prove that the ecosystem isn't just a charity case or a nice story, but a viable asset class.
It feels like they're on the cusp. They've survived the worst. They've built the structures.
And now they just need the wins. As Ambar says, success breeds optimism. One big exit changes the psychology of the entire region. It turns, can we do this, into, we are doing this.
It's a fascinating case study in resilience. It's not just about surviving. It's about evolving your financial model to match your reality.
Absolutely. It proves you can build a venture ecosystem almost anywhere if you have the discipline to adapt the rules.
We'll be watching closely to see who the first big exit is from Fund 2. And that does it for this deep dive into Iptikhar Fund.
A true masterclass in resilience.
For more stories like this, subscribe to Bayanat's newsletter and stay updated on the latest in MENA's tech and startup ecosystem.